So you may have seen the headlines recently. Cannabis is federally rescheduled. 280 is dead. It's a new era for the cannabis industry. And now look, there's some truth to that, but if you're a California CPA, the honest answer is a little bit more complicated. Today, I want to cut through the noise and explain what actually changed, and maybe more importantly, what didn't. I'm Matthew Martin, CPA and Managing Director at PDM LLP, with nearly 20 years experience in tax and advisory. With over the past decade, I focused significantly on the cannabis industry, helping operators navigate exactly the kinds of complex issues we're going to talk about today. 280E, inventory accounting, and managing risk in a highly regulated environment. Before we get into the news, let me give you a quick picture of where the cannabis industry actually stands today, because the context matters here. So, as we stand, 24 states plus Washington, D.C. have legalized adult use cannabis. 40 states have a medical program in place. We are no longer a niche industry. We're talking about an over $30 billion in annual legal sales in just the US alone. California is the largest cannabis market in the world at roughly $4 billion a year. But here's the thing, we've contracted from being an over $6 billion industry in the past. Our licensed operators are being squeezed by illicit competition, high taxes, and regulatory burden. Since 1982, Code Section 280E has been the defining financial challenge for the industry. It effectively taxes cannabis businesses on gross revenue rather than profit. And some California operators have faced effective tax rates exceeding 70%. And that's before you layer on California's 15% state excise tax, making this one of the heaviest combined tax burdens in any regulated industry in the country. Most cannabis businesses also remain underbanked. The Safer Banking Act has not passed through Congress yet. It is a cash-heavy operation with limited access to credit, and that's still the norm today. California's unlicensed market remains massive. It undercuts licensed operators on price every day. And that is a direct consequence of the tax and regulatory burden that rescheduling only partially addresses. So, if you have clients in this space, or you're considering it, know the landscape changed materially in the last few weeks. And this episode is about understanding what has actually changed and what hasn't changed. Cannabis has been a Schedule I drug since 1970. That's the same category as heroin. It means that there's no medical accepted use and it carries the maximum federal restriction. That classification is what made 280E apply to the industry in the first place. President Trump signed an executive order in December of 2025 directing the Department of Justice to complete the rescheduling process. The DOJ issued a final order on April 23rd, and it was published to the Federal Registry on April 28th, making it officially effective. So what did it do? It moved state-licensed medical marijuana and FDA-approved marijuana products from Schedule I to Schedule III. What it didn't do was anything for the recreational and adult use. That stays as a Schedule I drug. There was no broad federal legalizations. Banking laws have also not changed. So now, why does the schedule designation matter so much for taxes? Well, it's because of this one sentence, Section 280E of the Internal Revenue Code. And it says that no deduction or credit shall be allowed for any amount paid or incurred during a taxable year in carrying on any trade or business if such trade or business consists of trafficking in controlled substances within the meaning of Schedule I and II of the Controlled Substances Act, which is prohibited by federal law or law of any state in which such trade or business is conducted. 43 words. And that sentence has cost cannabis businesses billions of dollars. And the only reason it applied at all was because cannabis was a Schedule I drug. Move it to Schedule III, and that sentence no longer applies to medical operators. No act of Congress is required. So, what does that mean for you and your clients? Well, for state licensed medical operators, the relief, it's immediate. 280E no longer applies. For the first time, they can deduct ordinary necessary expenses, payroll, rent, marketing, just like any business. And that's starting with the 2026 tax year. There's also a bit of a retroactive angle. The Department of Justice order encouraged Treasury to consider 280 relief for prior years, going back to the years when a state medical license was implemented. Now, keep in mind that has not been authorized yet, so don't go advising your clients to file amended returns, but flag it as a potential opportunity and watch for when the IRS guidance officially comes out. Now, here's the California reality, and this is what the headlines miss. California's market is overwhelmingly adult use. Recreational operators dominate the business model in this state, and they are completely unaffected. Nothing has changed for them. Not their tax position, not their banking situation, nothing. For a dual license operator, those holding both medical and adult use licenses, the situation is the most complex. They'll need to apportion expenses between those two activities. And here's an important precision point from the Treasury's own announcement. The transition rule is going to be activity-based, not entity-based. A dual license operator does not, I repeat, does not get blanket 2026 tax relief, and that only applies to the portion of their activities that no longer involves a Schedule 1 or Schedule 2 substance. This matters enormously for how they're going to set up expense tracking going forward. One more California-specific note that often gets overlooked. Federal rescheduling does not touch California's own limitations or any other state's tax limitations on cannabis businesses. Luckily, in California, we don't conform to 280E, so we don't have this issue. But if you have clients in other states, make sure that you understand that this changed nothing unless they had automatic conformity. Now, a few things this order does not do. No banking relief, no interstate commerce, and no change for adult use operators. And counterintuitively, losing 280 doesn't simplify cannabis taxes. It actually introduces a whole universe of federal compliance that these businesses have never had to navigate before. Think about your interest expense limitations, your inventory capitalization rules, your accounting method changes. This is where you, as the CPA, become essential, not optional. Now, finally, I want to bring up that the Department of Justice order includes an express severability clause. In legal drafting, this signals that the authors anticipate challenges in court. This is not fully settled law. Counsel your clients to not overcommit to planning that depends on this order surviving. So, a few dates to have on your radar. April 28th, 2026. That's the official effective date. Treasury guidance is expected to apply 280 relief generally to the full taxable year that includes this date, which for most business is going to be the entire calendar year of 2026. IRS guidance is forthcoming, but it's not here yet. Do not file amended returns. Do not implement any major structural changes. Wait for the guidance. And then June 29th through July 15th. This is the date every California practitioner should have circled on their calendar. This is when the DA hearing on the broader rescheduling of cannabis, including adult use, begins. That's June 29th. That outcome is potentially the most consequential federal cannabis development in the history of the industry. Cannabis taxation has been a one-note story for a long time. 280 applies, deductions are disallowed, end of conversations. And that is starting to change. But changing tax law is never as simple as the headlines. And this one is no exceptions. We started today by saying the honest answer is a little bit more complicated than the headlines suggest. I hope this helped clarify what this means in practice. For California CPAs, the story today is really about two things: making your medical clients understand their new position and acting on it, and making sure everyone else is watching on June 29th. Know your client's license type, understand what the order does and does not cover, wait for the IRS guidance, and watch on June 29th. That's the playbook. That hearing could change everything, and we'll be back when it does. Thank you, and have a great day.